options to futures, we are talking 3 uses for futures. We're wrapping up the foundational pieces here. If you haven't watched the program before, go check it out in the archives. We got all of the episodes hosted on multiple actual places here. So go check it out. We talked about, margins with futures, contract specifications, and all of the nitty gritty of getting you ready for now using the darn things. And so today I want to wrap up a conversation you had with Peter Momet, Jermal, about how producers of agricultural products and other commodities use futures, how banks use futures. And then you arrived at how people like you, yourself and myself use futures. I want to put the microscope on that and talk about 3 uses for everyday people like ourselves to trade futures. And then hopefully we get you up and trading next week. What do you say about that, man?
Sounds great to me, my man. Let's do it.
Awesome. Let's start here with why futures were created for institutions and everyone else centuries ago, dating all the way back to rice farmers and everything in Japan, creating futures contracts, I believe in the 1800s. It still holds, though. Hedging for the everyday person is a fantastic use of futures. And I want you to give an example from your perspective of this. We've got the small technology futures. Now, say, Jermal, you have 10 grand, 20 grand, 30 grand, however much you've accumulated in a 401k or a brokerage account, maybe spread across both. You have X amount in investment. How would you use a small technology future, for instance, to hedge against just a passive stock portfolio that's long?
So, to get there, I want to start off at where my original training comes from. The idea of hedging is the idea of purchasing premium and puts, right? Purchasing, say I have, XYZ, let's say it's 10 grand worth of, Microsoft stock or something like that. Sure. And I'm worried about Microsoft falling someday. So I go out and buy puts. That's the original idea behind it. Now it's funny because that's something that, probably did for 10 to 15 years. But then rethinking the idea of options and volatility and paying for premium is just not something you really want to do all the time. So there's other ways of doing it, right? Like you can, go out and sell a call spread or what have you. But this is interesting in that looking at how to hedge now, like you just said, now I have a situation where I have this 10 grand of something else. Now I can look to buy some sticks, buy this small technology future in such a way. And so it looks like we have a little calculation down here. Walk me through this.
Yeah. And that's exactly right. That's why we love having you here on the Small Exchange platform to do exactly what you just did. Because I am so far removed from options and stocks and some of this ETF speak, I forgot completely about one of the most popular hedging strategies, which is the collar, right? Like the idea of buying that put and trying to finance it with calls, which is tough because skew, and I don't want to get too in the weeds, but skew is so that puts are more expensive than calls. So now I'm cutting off a bunch of my upside just to buy this protection. And the example is perfect. Like Microsoft has earnings, for instance. I've accumulated 10,000 whatever of Microsoft exposure over the years. And now this earnings could take me down that hits, tomorrow afternoon, maybe today, whenever the hell it is. And I don't want my years and years of investment to be wiped out in one earnings fell swoop. And so what do? I have to buy expensive puts. And so tomorrow, if nothing happens, which is, it's kind of, it's our go-to projection is that like at the end of the day, it might go down, it might go up, but the expectation theoretically is that nothing happens. Well, if nothing happens, then I just lost a bunch of money because I had to buy those puts. Now, what you can do, and as long, I'm glad that we're sticking in the technology world. Maybe I have shares of Microsoft, shares of Apple, shares of Amazon and everything else, and earnings season is approaching, and I'm feeling like this might be a bad earnings season for technology. What I can do is I can just sell one of these futures here. And so hopefully at the end of the day, earnings season passes. Maybe my stocks are up a little bit. Maybe they're down a little bit, but they're around unchanged, which is likely. This short futures exposure has no premium that I had to pay for it, right? And so
Yes.
the idea here is I've got X amount of investment value. Let's say, for the sake of conversation, I've got 50 grand invested throughout a whole bunch of tech stocks. I want to hedge a quarter of that exposure. So around $12,000, $13,000. Small technology contract right now is priced around 62 bucks. So times 100, that's a $6,000 give or take contract. So what I can do to hedge 25% of my 50 grand portfolio, Jermal, is sell two of those small technology contracts. And right there, if we see some turbulence, if we see some downside action in those tech stocks, I've hedged a quarter of it. I can jump that up to 50%. I can move that down to 10%, depending on how much I perceive there to be risk in the near term. And what's really nice is I can put that hedge on for a week of earnings, 2 weeks of earnings. It's real easy to buy back as well. And I didn't have to go through all of the premium purchasing in options. Does that make sense to you?
Absolutely. Totally makes sense. And so just so I'm aware and everybody else who's watching is aware, what is comprised? Like what is the small technology index comprised? Like, or I should say, what is it comprised of?
Sure.
How much FANG, or is there like is it like sort of like Qs in a way where it's like more than 25% of, the sticks is comprised of it, or, et cetera, as we're going to the small exchange website right here, people. Okay, cool.
Rarely do this. I would never do this for one Peter Momat, but for you, anything, my friend. Rarely go away from the slides, but it's so easy that I went and jumped to indexit.dxfeed.com. That's where you'll see the small exchange indexes, a lot of the information about them. And as you can see here, though we view this product as a unique product, and we'll get to how that uniqueness can lend to investment in its own right and speculation here in a second, it does have a lot of the same names. Like if you got Apple stock, it's got Apple exposure, Microsoft exposure, it's got Amazon, a lot of the stuff that is in your portfolio that you've maybe been accumulating since the 80s and 90s here, or if you've been investing just for the last few years, probably a lot of the stocks that you've been focusing on here. And funny enough, this is the stock sector that's been seeing the greatest volatility recently. Yes, and that brings me to kind of the next reason for hedging is like not only earnings season, but say just like you got a bad feeling today or this week. What's really nice about this is like I can sell this contract to hedge a portion of my portfolio and buy it back within minutes or hours, whatever I perceive the risk to be, whatever the time frame. Really easy and simple here, and you're not giving up anything in that option premium. Now I want to move on to the idea of investing using futures, because I know you probably, I love that you whipped out the collar for that analogy here, but this is a similar one in options that you find, which is like, I want $6,000, $7,000. I want thousands of dollars of stock exposure, but I don't want to pay thousands of dollars for it. What do people usually do? They reach for those long calls, which again, you're giving up a percentage. So maybe you talk about how like initial margin of 550 for $6,000 in stock exposure with the sticks product. It's similar to those out of the money calls, but maybe you can speak to the flaws in that plan.
Yeah, I mean, I've lost many dollars in my day buying upside calls because of for various different reasons. And there's times where I've been right, but there's been plenty of times where I was wrong, but just right, but in the wrong time frame. For example, sure. I mean, again, that's another thing. You got to choose the specific time frame that you want, whether it's 1 month or 2 months or 3 months. You got to you're holding upside calls, which in general, usually lose their premium unless you're through the break even over time. And so, in this case, I think it's a lot more compelling to buy these futures and not have to worry about time decay. I mean, that's the biggest thing with options, right? Like time decay. So that's the interesting part.
Well, yeah, it's just like I always come back to this, like in everyday life stuff and trading, which is like if I need a couple of things to go my way, it's unlikely. Like, this with probabilities, it's like if you have a 50% probability and then you stack on like oh, like a 78% times a 95%. Those are all 50% or higher. But guess what? Them combined brings me to lower than 50%. And so, like, if I'm buying calls that are even at the money, well, guess what? I need to be right by that amount of premium I paid. And in that time frame, it's like, God, how many things do I need to go my way? Futures, we talk about this all the time. When you buy or sell that future, 50-50 play there. What's really nice from the investment angle is you're usually on the buy side when you're investing. So if I buy sticks today, I've got a 50-50 shot. I don't have that, 30-70 shot of the 30 delta call when I go to buy that, for instance. And I'm getting the leverage here. I'm investing in over $6,000 worth of tech stocks that we just brought up for just barely over $500, and not giving away, oh, it has to be this time frame. I can roll my futures very easily. It has to be, by this amount. Like, I want to invest in this stock. It's at 100, but I'm buying the 110 calls. So I needed to get up to 110 before I even start making any money. That stuff just reduces your odds, and that bleeds out your account over time. Let's finish up with the idea of speculation, the third use here, but I think one that has become very popular, especially with the sticks contract, especially on a day like today, a week like this week. You see the selling come out of nowhere and it dissipates. You see the bounce backs. This is a nice trade here that moves about $100. It only costs $550 in initial margin to trade that back and forth, right? Like, and this is another one that you try to use options to scalp, for example. It's a tough one.
Yeah, and it's it makes me think of trading places. It makes me think of Billy Ray Valentine. I mean, when you're talking about the Qs right now, you're talking about what's going on in tech. They're scared out there. Look at them. They're scared. I can see it. I mean, you can see a lot of fear because of what's got the big run up we've had in the past year. The idea of what's going on with interest rates, although it's, the 10 years come down some. It's not 1.7 anymore, but still. I think a lot of people are nervous is what's going to happen with big tech. You see a lot of the pandemic darlings that are kind of struggling right now, but that's besides the point. The ability to be able to play this from the standpoint of just using futures, which is just pure, a pure play. I think it's really interesting and compelling to me.
And I'm glad that you brought up the QQQ idea here, because like, this is honestly one of the primary reasons why we created futures here from the small exchange is tech is moving. Everybody's got an opinion on, and tech is moving in both directions in any given minute or any given hour. But I go to QQQ and it costs me an arm and a leg to get something that, like, an amount of shares that's actually moving, $50, $60, $100 per day, costing me thousands of dollars to trade that. Okay, what do? I jump over to the NASDAQ futures. Oh, okay, these micro NASDAQ, these are only costing me, $1,000, $2,000, but that thing is whipping around thousands of dollars every single day. What we have here is that porridge bowl that's sitting smack dab in the middle of the one that's too cold, the one that's too hot. It's just right here. It's moving $100 per day. It only costs you about $500 so that you can have those opinions on the FANG stocks, the tech darlings that outperformed amid the pandemic coming to a close. How much are they going to give back? Flexible, appropriate size for speculation.